Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I definitely want to get his thoughts on the oil and natural gas market. Over the last month, we've just had an absolutely crazy move in the U.S. natural gas price. I guess this is the reason they call it the Widowmaker. Out of all the single commodities, a 50% down move in about a month. The natural gas price is at $1.68 when we're recording this interview on Friday, February 16th, 2024. West Texas Intermediate is at $77.67. I'm speaking to former Hess senior oil executive and president of the Energy Prospectus Group. He has over 30 years of experience working in the oil and natural gas industry. He also did mergers and acquisitions for a lot of oil and natural gas companies. Dan Steffens, thank you for joining me again.
Yeah, thanks to be back. We have interesting times. Yeah, we have three different markets in energy, fossil fuels here, so they're all going in different directions. Pretty interesting.
Yeah, the oil market has been in trading range, and we'll definitely talk about that. I think there's a lot of good bargains for U.S. and Canadian oil producers that are relatively low cost, and they have free cash flow at current prices. I have net asset value discounts of some of these companies easily around 30, 40, 50% for a lot of companies. But first, let's talk about natural gas, because there's a lot of crazy stuff going on in the natural gas market with the price move that I talked about. But since you know the industry really, really well, which companies in the oil and natural gas industry benefit from record cheap natural gas prices here in the U.S.?
Well, I don't know that any of the upstream companies benefit from. Probably some of the midstream companies benefit. Some of the ones with storage, which I don't follow, storage capacity, because storage capacity is staying pretty full. I mean, we began the winter heating season with more than normal gas and storage, and then we had that 1 or 2 weeks of very cold weather. That was promising, and then it just got mild again. So unless we have a polar vortex or something that happens in the next 2 or 3 weeks, and this can happen sometime in El Nino winters, you do have winter weather extend into April. That could help. But I think when the weather turned warm again, I think the reason the big price pullback, I think a bunch of speculative paper traders in the futures market have shorted natural gas now. And I think there's an abundance of short contracts. So if you happen to get a spike of really cold weather again, you could see a short covering rally that might put gas back over 2. But if you look at the strip, actually the strip prices for December and January next winter are over $3. So $160, $170 natural gas is not the quote right price. That is not a fair price. That's below break even for a lot of these gas companies. Now, some of them have some good hedges in place, so they're okay. And then also the other thing, what people need to understand is a lot of these gas companies have a lot of wet gas, what they call wet gas, that contains a lot of propane and other natural NGLs, natural gas liquids. And there's a huge demand for U.S. natural gas liquids. What's going on in the Red Sea? Those tankers, a lot of those were delivering propane and other natural gas liquids to Europe, and so Europe doesn't have that anymore. So they are wanting the U.S. and there's been a lot more ships, so we have more export capacity to get rid of our gas. It's just been in the last 3 months. The propane market in the U.S. was grossly oversupplied. We had the same inventory problem. We had inventories way above normal. Then that 1 week that hit the Midwest really hard, where people heat their homes and cook with propane, and our exports have wiped out that excess. Now our inventory of propane is actually below the 5-year average, so it's gone the other way. And I just checked before this interview, and propane is at $92 a gallon, which is the highest price in like 2 years. So the company that I like that does produce a lot of propane and other NGLs is Antero Resources, AR. And it does not pay a dividend. That's the only thing I don't like about it, but they're going to do really well. And they have a subsidiary, Antero Midstream, which does pay a very nice, like 7.5% dividend. And that's one to look at. And its symbol is AM. Range Resources, which is actually up year to date. I'm amazed. They do also sell a lot of liquids, and a whole bunch of their acreage is held by production, so they don't need to drill it. but they do produce a lot of liquids, and that helps them quite a bit. And they produce some oil. I think about 30% of their production is liquids, and they do sell some oil too. So I think now probably the majority of their revenues do come from liquid sales. So that those two, Antero and Range, look pretty good. And for dividend players, I think Antero Midstream looks pretty good too.
For the demand for propane, is it used for barbecue, so for cooking, and then for electricity, so like propane tanks and like a recreational vehicle, an RV, or what are the main uses for propane?
Well, in the Midwest, this is Texas, Oklahoma, up through Kansas, Nebraska. There's a lot of people. They don't have access to natural gas coming into their homes, so they heat their homes and cook with propane. And you get a cold winter. Propane doesn't burn very hot. You don't want to stick your hand in it, but it doesn't burn real hot. So you have to use a lot of propane to heat a home. And just one cold spell can, wipe out a lot of propane inventory around the country. But also, you go down into the Caribbean, a lot of the South American countries, Asia is even importing a lot of U.S. propane now. I saw somewhere where there's like 20 more ships just put in service in the last year that can haul liquefied petroleum gases. They call that LPG, liquefied petroleum gases. And that includes a lot of different things, propane, butane, and then you got ethane and all that. But the good stuff, which is like the propane side, it's a lot more expensive, has a lot higher price than ethane these days.
So for my question about who was going to benefit from natural gas prices crashing like this and being so cheap, I was actually hoping that you were going to say like U.S. oil refiners, some of the pipeline companies.
Probably the refining. The refineries use a lot of natural gas, some for power, and they also, they're able to blend some of the liquids that come out of the natural gas stream with their crude oil to make gasoline and stuff. But I'm not a refining expert. I didn't even do that at Hess. I was on the upstream side of the business.
Yeah, I think they use a lot of natural gas to heat and cool break the barrels of oil down into other necessary parts. So other types of plastics and other types of fertilizers. They mix out all the different petroleum products. But recently, I know, because we were discussing this before we start recording, Bloomberg has been laying out the argument that the refiners are they're switching over from using as much oil in the refining process to make, say, gasoline, jet fuel, and diesel. And they're buying these natural gas liquids because they're so cheap compared to a barrel of oil. Do you think that they're going to continue doing this, or do you think that that's going to drive the price up too much and the refiners will not be able to permanently switch over to natural gas liquids like Bloomberg is saying?
Yeah, well, and there's some chemical reasons. I mean, you can only blend so much butane into gasoline. See, a lot of butane is used in the gasoline during the winter time, but in the summer, it's against the law to have too much of that in there because it causes the gasoline to evaporate more. So you hear about winter blend gasolines and summer blend gasolines. Summer blend gasolines cannot have as much other gases like propane, butane, and stuff mixed in with the formula. But I'm sure there's very smart chemists and they've figured out how to bond these molecules or something. I think that's what Bloomberg is saying, and that's great that they could do that, because I tell you, if you didn't have some of this ability to reformulate some of these products, our gasoline prices and everything would be going through the roof. Now, the other winners on low gas prices, of course, is the consumers and any industry that uses a lot of natural gas for power or for a feedstock. A lot of plastics and stuff come out of the natural gas stream. So they should be the big winners too out of this, a prolonged thing. But I don't think it's not going to go on like this for years. This is just a short-term thing that'll probably within 6 months will get back to some more normal gas price. If you just look at the NYMEX strip prices for natural gas, they do run back up to $3 by December already.
So it sounds like it's a trade maybe for some of these refiners that they have lower input costs, like a Valero or some of these others that they're benefiting with their innovations here. Because I mean, a lot of this stuff, natural gas or natural gas liquids, these are still hydrocarbon chains. And I guess maybe they have to do a lot more innovation there, but they have cheaper input costs and maybe they can make some type of synthetic gasoline. I mean, weren't they switching over? The refiners were blending in condensates too. So they've been doing innovations like this where it wasn't all oil into the gasoline and the jet fuel and the diesel for years now. I think it was condensates for years, and now it looks like they're switching to NGLs. But at some point, Dan, doesn't that this starts to run out, especially if the Permian Basin oil production growth, if it doesn't keep growing and growing and growing?
Yeah, and then that'll just run the NGL prices up too. It's just another source of demand. But I think the exportability, if your listeners want to learn more about that, Antero in their quarterly presentations got some really good slides on how the NGL market has really, really picked up and really, really improved. So that's a good thing. That's a good thing.
So for this cheap natural gas, I mean, they're not flaring it off because I think that has stopped a long time ago. Does this benefit the pipeline companies? So I think there's only two pipeline companies that control the majority of the pipelines in the Permian Basin that go to the refiners to move that natural gas and the natural gas liquids, Enbridge and ONEOK, right? Don't they own the majority of the pipelines?
Yeah, and also Plains All American Pipeline, PAA. And I prefer PAGP, which is the general partner of PAA. They're big. In fact, Plains, I think, might be the biggest with pipeline access out there. ONEOK is they're an NGL. They handle a lot of America's NGLs. And I love that company. That's a great company. It's rock solid dividends. And they've told me and the market that they are going to increase their dividends quite a bit, like several years in a row until they reach a plateau of like 60 or 70% of their distributable cash. And they got a long way to go. Based on my forecast, there's going to be 3 or 4 more big increases in their dividends. So that's one to look at. That symbol is OKE. That's a very, very nice company. In Tulsa, when I office with Hess up in Tulsa, my office looked right out at their office building right across the street.
And also Enbridge. I was watching the CEO of Enbridge talk about how, and the other two companies you're mentioning, they're also making capital investments into expanding the pipeline networks and the amount of pipeline growth, the amount of natural gas and natural gas liquids that can be moved through the pipelines from the Permian Basin to get the natural gas out of the Permian Basin there. Because a lot of those wells, for our listeners out there, a lot of those Permian Basin wells, they have 30% or more of the energy production out of the wells are natural gas or natural gas liquids.
And what happens with those oil drills, the wells they drill for oil, so they'll almost give the gas away because they're producing the oil is where the big money's being made. But over time, the percentage coming out of the ground gets gassier and gassier. The gas to oil ratio increases in favor of gas as the oil depletes from the zone, and that's a problem. That's why they have to keep drilling more and more wells just to keep production flat. But Enbridge in fact, we're going to publish a report on Enbridge tomorrow, an updated profile. It has a market cap of $73 billion. It is the largest by far, by a wide margin. ONEOK is second at $42 billion market cap. But Enbridge is a world-class company, pays a very nice dividend, I believe about 7 or 8%, and it's got a lot of upside. That stock looks really good.
So there's only 3 companies then, and they control almost all the pipelines in the Permian Basin for natural gas and natural gas liquids. So that's almost like it's a near monopoly then for the 3 companies.
Yeah. And now Enbridge is not in the Permian Basin. They're a Canadian company, and they bring stuff down from Canada, but they're also merging with a big distribution company to take natural gas to people's homes. It's a very complex company, much bigger than just some of the pure pipeline companies. But I like it. It's a great company, no doubt about it.
Oh, if I remember correctly, the Enbridge CEO was on Fox Business, I think on Monday or Tuesday, and he was talking about how they're going to be investing heavily into the Permian Basin. So I don't know.
Maybe. Okay. Maybe they're going to get into some new stuff. Okay.
Yeah. I think they have a plan over the next 2 to 4 years. They're spending billions of dollars into the Permian because they still see it as a growth area, especially for natural gas and natural gas liquids. So he was on, I think, Liz Clayman, and he was talking about all the growth that they're investing in the Permian. So I think those are going to be the 3 companies that are going to have a lot of control over the pipelines coming out of them.
Yeah. Okay. And they are definitely a big M&A company. They're growing through mergers.
So for natural gas liquids, you mentioned the producers and the pipeline companies. Do you expect Permian Basin oil production growth to continue, or do you think that eventually it's going to hit a peak or some type of like, I don't know, plateau, and it's going to stay there? It's going to be difficult to grow production.
Yeah, even the EIA, our own EIA, is saying U.S. production is going to flatline. I mean, they're still predicting that in fact, the only place where there's growth in the United States is going to be the Permian Basin. The other ones are declining. Eagle Ford is declining. Bakken's probably peaked. There's some stuff in Oklahoma and Powder River Basin, some of that stuff, but the Permian will eventually peak. Every oil field ever discovered is going to peak. And what you're listening is there's been all this M&A activity in the Permian Basin. Well, that doesn't mean the production is going to increase. Usually after M&A, and I worked in M&A for a long time, when you make a big merger like that, it takes some time to, merge all the people in and get all the properties set up in your system and decide what you're going to do with the field workers and everything. So usually there's a pullback. I'm looking at Diamondback right now that just announced that big merger with what is it? Enbridge and I can't. A big one. It's a private company, but anyway, it's not going to close until the fourth quarter. And they've said they're going to drop 4 rigs while they integrate the two companies together. Endeavor's the name, but I'm sorry.
There's actually a lot of mergers and acquisition proposals. Occidental Petroleum, there's a proposed deal with a private company for around $12 billion. The regulators haven't approved it yet. It's ridiculous. We have to go through all this regulatory process. But it just shows that with the cost of capital where it is, that capital's not easy for these private oil and natural gas companies, especially if you're an SEC credit investor. You can just park a lot of your savings in short-term treasuries and earn almost 5% for short-term treasuries.
Yeah. So anyway,
Bakken,
go ahead.
Well, I want to ask you about the Bakken. So, I mean, the Bakken did come. There was a spike in Bakken oil production increases, but that's when the Russia in early 2022, when oil prices were over 90. So, I think we could have a temporary spike again in the Bakken, but it's not cheap oil production. It needs like $80-90 a barrel minimum, and it needs to stay there for months, I would say.
Yeah, there's talk that Devon Energy is going to merge with Enerplus up there, and that's to get their Bakken stuff. But that'll make them a big player in the Bakken again. I used to follow Enerplus really carefully. It's a nice company. They've sold off a lot of their Canadian stuff, so they're pretty much even though they're based in Canada, pretty much a pure American company. But that's a pretty good deal. Devon pays a nice dividend too, so that's one to look at.
Now, I know you cover a lot of these companies in the different model portfolios. Are we looking at discounts to net asset value? So that's net present value of future discounted cash flow. Are we looking at some of these producers at a 50% discount to net asset value now for a lot of these U.S. and Canadian oil producers?
Yeah, especially some of the Canadian companies that I follow, some of these smaller Canadians, they're basically selling for their proved developed producing. No profitable upstream company should trade below PV10 net asset value of their proved reserves. And I mean, I bet half of the companies in our model portfolios are trading below P1, which is proved, developed, and undeveloped, but that's what the SEC proved. Because SEC proved reserves based on the SEC definition is very conservative. I mean, a lot of these guys that have a lot of shale, you could even count their 2P, which is their probable reserves, as proved. But you can only count them as proved if you are going to develop it in the next 5 years. So a lot of these companies have a lot more asset value than what they're trading for. That's for sure. And on the Canadian ones, 2 large Canadian companies that I like are Baytex and Crescent Point. And I think both of them, hang on here. Yeah, Baytex closed on Friday below market, below book value, almost $1 billion below book value. They closed. That's crazy. They're a profitable company. Made $2 a share in 2022. They're not going to make this much this year, but they're still generating a lot of cash flow. In fact, they're trading at less than or just below 2 times my 2024 operating cash flow forecast. That is an insanely cheap price for a stock it's profitable with a lot of running room They merged with Range Oil. In fact, most of their growth in the next year or two is going to come from South Texas and Eagle Ford. They bought a company, Range Oil, that had some really good assets in the Eagle Ford. And anyway, that's a keeper right there. Eric Nuttall loves that company.
Eric Nuttall used to work at Sprott Energy. He was their oil and natural gas portfolio manager, and now he started his own oil hedge fund. He's on BNN Canada, or BNN. It's not BNN anymore. Bloomberg bought it. So it's I can't remember the name change of the company. Bloomberg News bought BNN, so I can't remember the name change of the company. But he's on there for interviews. I think he also likes Surge Energy. I think Surge Energy is another one with a lot of free cash.
I follow Surge. Surge pays monthly dividends. It's really nice. In fact, I talked to their investor relations person yesterday, and they're going to come down and host a luncheon for us in Houston to get to know our investors. And our guys love companies that pay monthly dividends.
So, Dan, since you've been through so many cycles, you've seen interest rates go up, interest rates go down, cost of capital go up, cost of capital go down. You've seen valuations on companies at these levels in past cycles. What normally happens in past cycles when cost of capital is this high and valuations for oil producers are this cheap?
Well, what we're in now, you still have a lot of people that have this false paradigm that EVs are going to somehow lower demand for oil. And, I follow some of these guys like Adam Rosenzweig, and you mentioned Bloomberg and stuff. The oil demand is just going to keep going up. You have 3 billion people on planet Earth trying to have a higher standard of living. And that only comes with abundant and affordable energy. And that's not going to come from wind and solar. These countries cannot afford to spend trillions of dollars on wind and solar. And they're going to be using fossil fuels for a long time, especially oil and natural gas. In fact, that's why I'm really long-term very bullish on natural gas. All we need is more export capacity, and we're going to have 5 or 6 of these big LNG export facilities, new ones coming online in the next couple of years that should solve this oversupply problem. It's really been we just had 2 mild winters in a row. And so if we can get more export capacity, then the same thing with the dry gas will happen. That happened with the NGLs. We'll have access to the global market for gas, and that's a much higher price than in the U.S.
I don't see a scenario where demand will collapse for oil or natural gas. I mean, even if we build dozens of new nuclear power plants, that's still going to take a long time. And that assumes that the governments actually allocate the capital and that the nuclear power plants come in on time and on budget, that the politicians are actually going to do what they say. I mean, they're still talking about allocating capital to wind, solar, biofuels. I would argue that the return on investment that these governments have allocated for wind, solar, biofuels, it's either zero or negative if the solar company or wind company goes bankrupt or needs a bailout. What's really funny, Dan, this is the most hilarious thing. So you see all these announcements for the last 12, 24 months about how they're going to reduce gasoline usage. They're going to phase out internal combustion cars, all this stuff. And yet in 2023, there was a record global demand for coal.
I know. Because here's the problem with wind and solar. And I listened to an hour-long interview with Adam Rosenzweig there. If people think wind and solar, that wind's free and the sun's free, so that's just free energy. Yes, but the upfront capital cost to build these things is extremely high. And now that we have high interest rates and the cost of capital is so much higher, there's a whole bunch of wind projects that have been canceled. Wind and solar projects are going to go bankrupt because of their upfront capital costs. They'll never pay out with these capital costs, and they're being defunded. I'm hearing that like crazy. And
there's a lot of other problems too, Dan. I mean, there's
maintenance problems too.
Well, solar panels break down faster than people realize, so they're expensive, and you have to replace them. A lot of these solar panels don't last 10 years. If you stick wind turbines in the ocean, look at New Jersey, or other places, those things, they hurt the animal life in the oceans, and then they don't last as long, especially if they're being exposed to high wind and salt water. They're going to break down faster. The other major problem is all the electrical grid. I mean, if you start building out these things, you have to have a better electrical grid in place. We don't have that, and we don't have good battery technology. We're nowhere close to any of those things.
Yeah, nowhere close to any stuff. And the thing is, it's when you just think about this, people need to understand the complex supply chain of energy that's been built to deliver all these fuels. oil-based, natural gas-based fuels and energy, coal. It's huge. I mean, gigantic infrastructure. If you're going to then replace that with a completely different form of energy, you're going to try to electrify everything, electrify all cars, and electrify everything. Nope, you can't, have a gas stove in your house or something. Think of the massive build out you're going to have to do to the power grid. That's what it's just like impossible. You're replacing one form of energy with another form of energy, but the delivery system doesn't exist yet to do that, and the cost of it is just going to be unbelievable. I don't know how many trillions you're talking about, but we can't afford it, that's for sure.
Well, they have to also assume that the copper is going to be there, and if copper prices are sub $4 a pound, there's definitely not going to be enough copper. So, I mean, if copper is going to go to $10 a pound and stay there for 10, 20 years, then there will be enough copper. The problem is you have all these people saying, China housing bubble, the copper price is going to crash. The copper miners aren't going to invest in new supply, and you can't build an electrical grid without copper and silver or rare earth elements and some of these other key materials.
I know it's mind-boggling, and that's the thing. People cannot grasp the size of the thing you're trying to replace. They just can't grasp it. It's too big. I work with it all the time, and I can hardly grasp how big it is sometimes.
Well, also the commodity prices, a lot of the metals prices during the inflation spike, they were only high for about 18 months, and then they went back down. That didn't give the commodity suppliers a lot of time to bring new supply online. So, in fact, a lot of projects are being delayed.
Yeah, I think we're going to see a big bite from inflation again. Is because diesel prices are going to go through the roof. We talked earlier about blending NGLs in to make gasoline. You cannot blend that stuff in to make diesel. You need black oil. I call black oil or heavy oil to make diesel. And there's a big diesel shortage right now already. Our inventories are 7 or 8% below, and they're going to get a lot worse when you get into the planting season because a lot of diesel is used by farm equipment. So, and it's a global problem. It's not just here. It's also in Europe. You just need more black oil, and these shale wells produce very, very light oil. A smaller molecule, and you can't make diesel out of it. So the world runs on diesel, and nothing's going to change that anytime soon.
Yeah, I agree. The entire supply chain, so especially the food that goes to the grocery stores, the truckers, a lot of that equipment, it all runs on the supply chain for moving goods or food from the grocery store, restaurants, consumer staple stores. It all runs on diesel. Not electric vehicles, not electric vehicle pickup truck that people don't put anything in the flatbed.
And I remember when diesel prices were a lot lower than gasoline prices, and people wanted to buy a diesel Mercedes or something because it was cheaper, and diesel burns hotter, so you could get better mileage with a diesel and stuff like that. But anyway, but not now. Drive down the highway sometime, you pass gas stations where diesel's $1 a gallon more than gasoline right now, I think.
I want to ask you about liquefied natural gas. So Biden has put in this new legislation, but only, I think, 18 months ago, he said that he was actually going to fund at artificially cheap interest rates new LNG export facilities, but none of the LNG export companies got any of the artificially cheap debt to go and build the facilities. So that what Biden said back 18 months ago, that didn't happen. What do you think is going to happen with these liquefied natural gas export facilities? Are they actually going to get built? Or are they going to get halted? What do you think will happen?
No, they're going to get built, and I got a slide in front of me that I copied from Antiro's presentation. Between now and the end of 2027, we're going to place in service another 10 BCF per day, another 10 billion cubic feet per day of LNG export capacity. There's three big plants that are going to be coming online. One is just an additional train down at Corpus Christi. There was actually a floating, it's called New Fortress FLNG. It is being placed in service now. It's a pretty small deal, but then the big one, the next one to come online in the third quarter is called Plaquemines. That's a Louisiana name, but it's Venture Global is the one sponsoring that. But it's a pretty big deal, and it's going to add about 2.5 BCF per day in the third quarter. And then in the fourth quarter, Golden Pass, which is Exxon's deal, is coming online, and there's a third train down in Corpus Christi coming online, and those two put together are going to add another 2.5. So from the end of year-end 2023, our export capacity was 14.5 BCF per day, and by the end of 2024, it's going to be 18.6 BCF per day. Now, if all that does come online and stays online, that pretty much, that additional, what is it, 4 BCF per day of additional demand will solve all this weather-related problem. We actually need more gas and storage. If you look at gas on days of demand instead of just comparing it to the 5-year average, and we used a lot. The gas market is much bigger than today than it was 5 years ago.
So all the talk right now in the stock market is about artificial intelligence stocks, NVIDIA, those types of companies, the tech companies. And I would argue there's a tech bubble 2.0 with the valuations on some of those companies. We could see a crash in the next, 6 months. Things are just getting out of hand. But let's assume that artificial intelligence, the investments from large corporations, it does go through. Did you see the IEA projections about global electricity demand? If Bitcoin mining, if big data, if artificial intelligence, those investments do start to increase massively and increase productivity. Did you see the global electricity demand increases for their high case scenario 6 to 7 years from now?
No, I didn't. But the only way to match that, I think, is natural gas-fired power plants or coal and natural gas-fired power plants. The only way to do that. You can't build nuclear plants fast enough, I don't think.
Yeah, I would agree. Not unless you're in China and you're going to skip a lot of the red tape and some of the
safety stuff.
Yeah. So I'll fill in for the listeners. I went through the research on the IEA and I found this, and they're actually projecting in the high case scenario, if Bitcoin mining keeps increasing, big data. So these are the data centers that a lot of people are using for internet usage, and you need all these technologies stacked for artificial intelligence. So a lot of people just think, oh, I can run it through a software program with ChatGPT. It's a lot more complicated than that. You have to have big data centers, a ton of data centers. So you're running big data networks. So ChatGPT is filtering a ton of information. These data centers that are going to be built, I mean, they're going to use a ton of copper, a ton of electricity. The IEA is projecting, Dan, that 7 years from now, global electricity demand with these new technologies could be double.
Well, I don't know where they think all that energy is going to come from. That's a lot of energy to produce that.
Oh, and electric vehicle usage too. Yeah. Still got
to produce that electricity. Batteries are not a source of energy. They're just like your empty tank. You have to refill them. And you're going to refill that by plugging it into the grid. So something's got to put that electricity into the grid. I don't know.
So all these technologies that people are accepting, like Bitcoin mining, data centers, artificial intelligence, I mean, they're going to use a lot more electricity. I don't think the market's accounting for any of this right now, because the policy decisions, Dan, are basically like, we need to phase out internal combustion engines. We need to phase out fossil fuels. And like you said, I just don't see a scenario.
Yeah. How do you electrify everything? You just can't electrify everything.
Well, if
build out of the grid. Yeah.
Well, if China upgrades their electrical grid, and copper demand in China shockingly increased in 2023 when everyone thought it was going to go down. I mean, if they're going to make upgrades and more people are going to use electricity and get on the internet, the electricity usage it's not going to go down permanently. It's going to keep increasing substantially every year, every couple of years.
Yep. It's interesting. It's energy demand just keeps going up. It's just, what form of energy is it? We're going to need all of the above. That's for sure.
So in this environment, a lot of people have the option of parking their savings in short-term treasuries around 5%. What are some of the oil and natural gas companies you think that have some of the safest dividends right now that are comparable to the 5% in U.S. treasuries?
Yeah, our model, our high-yield income portfolio, and we have 12 companies in there. 4 of them are minerals or /royalty companies. I really like them, and if you're bullish, especially on oil, I like Viper Energy. VNOM would be my top pick there. There's also a smaller one called Kimball Royalty Partners, and that's KRP, pays a really nice dividend, and it's got a good mix. Now, it's got some gas, but it also has LNG and oil production. It looks pretty good. Now, on the upstream companies, there's a company pretty good size called Civitas. It's got 2 core areas. One is in the Permian Basin. The other one is in the DJ Basin in Colorado. This company pays about a 12-14% dividend, very nice dividend. They have a fixed and variable part of it, but based on my formula, my forecast, they're going to be paying out about a 14% dividend yield over the next this year, and that one looks pretty good. Now I have two small Canadian companies, Hemisphere Energy and InPlay. These are really small companies, but they both are almost debt free. Hemisphere is debt free. They have more current assets than their total debt, and InPlay is close to it. And InPlay pays monthly dividends. I like Hemisphere a lot. It's the smallest company in our deal, but it trades as HME on the venture exchange and HMENF in the pink sheets. But you can buy it. I have a lot of pink sheet companies. Now, in the midstream companies, we talked about Enbridge and ONEOK and Plains and Antero Resources. So they all pay decent dividends. They pay smaller dividends, but they're considered the safest play. They're the midstream companies are all have very long life assets, and they're almost like a utility company that pays and pays and pays. So the less risk, but there's some good ones in there. If any listeners want to send me an email or something, I can send them our high yield income portfolio, and they can look at those companies.
In your opinion, why do you think some of these Canadian oil producers are selling at such a huge discount to net asset value? Are they selling oil that's at a cheaper discount to, say, West Texas Intermediate, or are there other reasons why, in your opinion?
No, but they always seem to trade at a lower multiple of operating cash flow. And then if you have this paradigm shift that we're going to be using this stuff longer, that's kind of that. Also, there's a pipeline up there called the Trans Mountain Pipeline that's going to be able to take oil to their west coast, be built across the Rockies. It gets placed in service in just a few months, and that's going to allow them to sell their oil to put it on the ships and sell it to Asia and stuff. And they're real excited about that because that's going to lower their differential to U.S. oil prices up there. And that's really going to help a lot of these companies. And that's why, do a little research on Trans Mountain Pipeline, and it's going to be placed in service in just a few months. And it's going to triple its capacity to get oil to the West Coast.
Oh, that's very interesting. I didn't know that. So that pipeline is a replacement then for the pipeline that was blocked by the environmentalists that was supposed to take the heavy sour Canadian oil down here to Gulf Coast refiners?
Yeah, it doesn't really replace Keystone. It's helping them get more access to the global market, yes, in that sense. But this pipeline's going west to the West Coast, and then they're going to have terminals loaded on ships on the West Coast. But what they're really doing is they're running some pipe next to an existing pipe, so they're going to triple the size of the capacity. And I think it's going to be up to 900,000 barrels a day. For Canada, it's a pretty big deal. That's about 20% of their total capacity, and that really debottlenecks them up there. Now, low gas prices are also hurting the Canadian companies. The reason I like Hemisphere, it's 100% oil. It's a 100% oil company, so it doesn't get hurt by the lower gas price that some of these other guys do. InPlay, about a third of their production is natural gas, but it's still a very profitable company.
Yeah, I was bringing that up from a global perspective because when I was an oil analyst, it was conventional knowledge, well known that a lot of Canadian oil always sold at a discount because it was kind of trapped.
Yeah, so their only market is the U.S. That's it. So now they're going to get more markets to Asia off their West Coast terminals.
Yeah. So for our listeners out there, a lot of the heavy sour Canadian oil, it used to sell at steep discounts because it was a pain in the ass transporting it in different ways to get it to a global price. So it always sold at a discount for the extra transportation cost. But if they build out the pipelines there, then they'll get a better price for it.
Yeah, the Keystone Pipeline was to bring heavy oil to our Gulf Coast refineries so that we could make more diesel. So when your food costs go up again, they bitch because the diesel price is high. Guess what? It's because we stopped building the Keystone Pipeline. We're
Okay.
doing stupid stuff.
Okay, last question, Dan, before I let you go. So with this
Okay.
natural gas price, we'll get back there. You said you wanted to bring up EQT. So I have listeners asking about, can these
Oh, okay.
low cost natural gas producers like an EQT, can they survive? How long do you think that they can survive this environment of a low natural gas price? How long are they hedged, and are they can they survive this for, I don't know, 12
Oh,
months?
they're going to survive, and they do have some good hedges in place. And EQT also produces a lot of NGLs. So it's going to be fine. We just published a profile on it the other day, and they're going to be cash flow positive. They don't have any problem. They're not going to go out of business or anything. They look really good. In fact, let's say it's down about 10% year to date, but it's a solid company. I mean, the stock price tripled over the last like 3 years until this year, so it was due for a little bit of a pullback. Anyway, it's going to be fine.
As we wrap up here, please tell my listeners about the Energy Prospectus Group and your model portfolios.
Yeah, you can join Energy Prospectus Group as a subscription service to get our reports. I don't handle anybody's money. I'm not a money manager or anything. They're just wanting to get our independent reports on these companies. And we have 3 model portfolios. We have kind of a mid cap, large cap, one guy called the Sweet 16. It's limited to 16 companies, very high quality. I think 13 of the 16 pay dividends, and they're all growing. They're all profitable. They all have a lot of what I call running room with good assets. Then I have the small cap growth portfolio that hadn't done that well this year or last year, but it's got a lot of upside if oil prices firm up, and it is heavily weighted to oil. And then we have the high yield income portfolio, and the priority there is just companies that have super strong balance sheets. Their dividend payments are secure, and a lot of them, there's 2 or 3 of them in there that have already told me they are going to increase their dividends in the months ahead. So, and I think that the average dividend yield is about 8.5%, 9% at the current share prices. So I think you can join EPG. It's just go to Google Energy Prospectus Group, and or send me an email at Steffens, DMSTEFFENS @comcast.net, and I will send you a link on how to join, and just ask me for a free newsletter if you'd like to get a sample of it.
There's a lot of bargains in oil producers in the
There
U.S. and
sure
Canada.
is.
If you look at profits for the oil industry and ExxonMobil, I mean, we're talking like the entire industry has way more profits than Nvidia, and Nvidia has just an absolutely insane market cap. So the market has gone way ahead of itself on artificial intelligence. We're starting to see some of the more astute investors with long-term track records, big shot former hedge fund managers like Stanley Druckenmiller. They're taking profits from the tech companies, the big tech companies, Nvidia, the artificial intelligence stocks, and they're rotating those profits into the cheap, undervalued, discounted cash flow, hated companies like oil companies and gold miners. So I think we're going to see more of that cycle rotation from a lot of hedge fund managers going forward.
Well, as they're releasing their fourth quarter results, I'm seeing some of these companies get an uptick in the stock price because it's proving, they sold their oil in the fourth quarter at $75 and they made a lot of money. They're very, very profitable at $75 oil, and drilling costs have come down. And I mean, their well level economics are outstanding at $75 oil.
Plus, we could see the rig count start to come down further. So I don't think we're going to see a dramatic oversupply continue for that much longer. And then I think the refiners are going to work through that excess, and oil stay range bound maybe. Because I don't see, at least for the short term, because I don't see OPEC having any incentive to bring on a lot of new production either.
No, I don't know. They're not going to do that.
Well, I really enjoyed our discussion today, and I look forward to speaking to you again in a few months.
All right. Thanks a lot.